Hey guys, Lincoln here. Today I want to talk about asymmetric risk and how it can help you change your mindset and change your net worth. Let's jump in. Asymmetric risk is the holy grail of risk. Asymmetric risk is the existence of a greater chance and or amount of upside potential than downside potential in an investment. So, is this a good thing? It's very good. You stand to gain much more than you stand to lose. Want some examples? Here's three. The first is there's a high chance of upside combined with a moderate reward, a moderate amount of upside. Apple is a great example of that. Today, if you invest $1,000 into Apple, you can expect that with a high degree of certainty to continue to grow because Apple is such a great business. They have such a great brand and a loyal following. So there's a high chance that your investment of $1,000 will only grow. So of course there will be ups and downs in the market, but over the long term, your investment is sure to grow because of Apple's history of success. And of course, because Apple is so far along in its business, because it's a mature business at this point, there's not a great amount of upside potential, but there is a moderate amount. So you're not going to 10x your investment anytime soon. But because Apple is such a mature company and it's not growing as fast as it once did, you stand to gain only a moderate amount of upside. So your reward in this case wouldn't be great, but it will be a lot better than there is downside. Then there's high chance plus high reward, and in this case, in this example, we look at Tesla. If you invest $1,000, if you invest $1,000 into Tesla, there is a very high chance because of the amount of support that Tesla has and because of the amount of experience the team behind it has. There is a very high chance that your investment will increase as time passes. And with that high chance comes a high amount of reward. So your investment won't only double or triple. There's a good chance that if you are patient enough, your investment will 10x or even more. When Tesla first IPO'd in 2010, they IPO'd at $17 per share. Today, they're at over $1,000 per share. That's because they're in high growth mode. They are still young and still growing. There is still a very large amount of upside potential. And the downside potential here is you lose $1,000. But again, that's unlikely. And if it happens, hopefully you don't need that $1,000 and it wouldn't be a shock to your bank. It wouldn't break your bank account. Next is moderate chance at upside plus high reward potential with very insignificant downside. So the idea here is that you have a greater chance than not to realize upside, and that comes with a great amount, a very high amount of reward. On the flip side, if you realize downside, it should be insignificant to you. So this wouldn't be an amount of money that would be a significant portion of your salary. This would be an amount of money that you could make back in a month, in 2 months, right? Or even a week. This will be an investment that you wouldn't really care to lose, and there is a low chance that you will lose that amount of money. A great example here is investing $1,000 into a SPAC play, a special purpose acquisition corporation. So think Tattoo Chef. Tattoo Chef and FMCI are going to merge and become one company. And the way they're doing that is through a SPAC. So when you invest in a SPAC, your downside potential, your downside exposure is very limited if you get in early. Because what happens in the SPAC is the fundraiser puts the funds into a trust fund so that if the deal doesn't go through, they will be able to pay back investors the baseline of their investments. So if the initial price per share of the SPAC is $10 and you invest at $12 per share, the most you can lose is the difference of that $12 per share and the $10 baseline initial price of the share, because the SPAC's trust fund guarantees that they will have enough to pay back that baseline price per share to investors if the deal falls through. So now that we know that there is limited downside, how about the chances of upside? With a SPAC, you have to make sure you're investing in a company that you believe is going to succeed in the future. So in this case, if we think FMCI and Tattoo Chef, I believe heavily in Tattoo Chef. I believe that there is a least amount of a chance that the deal will go through. Then if the deal goes through, there's even a greater chance of upside from Tattoo Chef. And if that upside is realized, the amount of the upside will be so high, I would be a fool not to invest in such an opportunity because it's asymmetrical. There's such a higher chance of me realizing great upsides, great gains in the future than there is of me losing a significant amount of investment. So again, if I invest at $12 per share and the initial cost was $10 per share, I stand to lose only the difference of those two numbers. So $2 per share is what I stand to lose. But I stand to gain a unbounded amount of upside. So Tattoo Chef could go on to be worth $20 per share or $50 per share or $100 per share. Or in the future, $1,000 per share. Think of Tesla. Tesla was once worth $17 per share. Today they're worth $1,000 per share. Anyone looking back would say, wow, that was such an asymmetrical risk. But of course, that's hindsight, and that's not how we measure risk. Risk is forward looking. So our example here still stands that with the SPAC play, if you invest in the company that you believe in, that you understand, and that has a great chance of upside potential with great rewards as well, then this risk is asymmetrical if the downside is low and insignificant to you. And it would behoove you to invest in such an opportunity. So that's what asymmetric risk is, why it's such an important concept to understand, and how you can use it to change your mindset so that you can invest in amazing opportunities that have great upside potential with a great chance of success and low insignificant amounts of downside potential. Thank you for taking the time to watch this video, and I hope that you will take this with you as you start your investment journey and learn to spot asymmetric risk so that you can take better risk. There is no better risk than asymmetric risk. Hey guys, thanks for watching this video. If you enjoyed it, please take a second to like and subscribe for more videos like this, and share this video with one person you think will find it valuable. I'm Lincoln, and I'm happy to bring you information that helps you change your mindset and change your net worth. Have a great day. Hey you, yes you. If you're just getting started investing, there's no better place to start than Robinhood. I have a link below that you can use to get a free stock when you sign up to join Robinhood and start investing today. So take advantage of it, and if you do, I'll thank you because I'll get a free stock too. It's a win-win, and you'll be off to a great start in your investing journey. Thank you.